All right. I want to thank everybody for attending our Wednesday webinar. We have our presenter, Matthew Winston from Truist Bank, and I will let him introduce himself.
Hey, good morning. Well, good afternoon. Matthew Winston. I am here with Truist Bank. I am the multicultural banking leader with Truist, and essentially my whole role is to just get out in the communities and bring financial literacy and financial education. And so I'm going to go ahead and share my screen. Awesome. And so gonna get started. And today's whole presentation is literally around the basics of banking. We're going to talk about budgeting and just answering questions. So I just want to start off by saying anytime you have a question, feel free to put your question in the Q&A section or ask your question. You can take yourself off mute, but it's an interactive presentation. So feel free to ask away. I'm here to be a resource. Also, I know I can't answer and solve for everybody's individual financial situation throughout our time together today. But I just want to start by saying, here is a starting point with some great information. And then also, if you want to talk more in depth, we're here for you too as well with Truist. And so again, my name is Matthew Winston, multicultural banking leader here with Truist. And you might be saying, well, who is Truist Bank? Truist is coming from the merger of BB&T and SunTrust. And so we merged earlier this year, back in February. And so we are now Truist Bank. We're actually the sixth largest bank. But our whole purpose is to inspire and build better lives and communities. And we say we can't actually live out on that purpose if we're not partnering with community organizations and getting out into the communities that we actually serve. And so, as we're going to talk through today, again, there's going to be several things that we're going to go over. But the first thing I want to just talk about is how do you determine your actual financial situation? And so, when you're thinking about determining your financial situation, a couple things that you want to go through. You got to first determine what you actually spend your money on, then determine how much money you earn each month, how much disposable income you have, your financial priorities, and then we'll talk about setting goals too as well. And so I want to just start here talking about tracking your expenses. And the reason I want to start here is because as we think about budgeting and managing your finances, the biggest piece that I find that a lot of people struggle with is truly getting down and starting to track your expenses. You have people that say, oh, I know exactly where my money is spent, every single dollar, every single penny. But then you also have some people saying, I kind of have an idea. And then you have some that say, well, what I don't know won't hurt me. And what I will tell you is if you're going to start managing your budget, the first thing that you really want to focus on doing is actually kind of focusing in. I'm going to see if I can zoom in a little bit more on this too as well. Let's see. There we go. Hopefully that'll allow you all to see it. But to focus in on as far as your actual expenses and don't discount anything. And so when we're talking about going through your expenses, things such as your personal and family expenses. If you pay daycare, babysitting, clothing and shoes, donations, all of that, right? Also food, groceries, household, include anytime you're eating out. I know sometimes people don't even like to include their coffee stuff. If you're a Starbucks person or if you're a Dunkin' person, add that in there. Also track your auto loan payments, credit card payments, your department store credit cards. So if you got a Walmart, a Lowe's, Home Depot, Macy's, any of those cards, tracking all that, your student loan payments, personal loans, keeping a tight track of that. But then even household expenses too as well. So your rent, your mortgage, your property taxes, insurance, how much you're paying for your electric every month, your cell phone, your cable, your internet. You really have to get granular. And the reason being is because when you're looking at, we're going to talk about your overall budget and how you determine your disposable income, but a part of that is knowing exactly your expenses. And so that way you can figure out what is your disposable income. And so this just shows a couple ways you can track it. You can track it weekly, monthly, yearly. There's some other ways you can do it too as well. So if we go on to talking about determining your disposable income. So your disposable income essentially is the net income minus your total monthly expenses. And so literally that's just what you have left over. Now, what I'm going to tell you is when you do your net income minus your monthly expenses, one of two things is going to happen. You're either going to have money left over, or you might say, oh, okay, I am either breaking even or I'm running up a little short. And this is why it's important to have this breakdown, right? And so when we go through this, and you may be saying, okay, well, what is disposable income? Disposable income is going to allow you to do additional things towards your financial goals and your priorities. And so whether your financial goals and priorities are to save for emergencies, whether your financial goals and priorities are to pay down some debt, whether your financial goals and priorities are to actually save for future expenses or anything of that nature, this is going to be where your disposable income comes into play. So thinking about setting goals for yourself. We talked about whatever your goals are, but talking about your goals, let's talk a little bit. Anytime you're making goals, especially financial goals, you want your goals to be smart. And so when we say smart, we mean specific, measurable, attainable, relevant, and time bound. And here's why you want your goals to be smart. It's one thing somebody could say, oh, I just want to make sure I save up going by the end of the year. I want to have some money saved up. Well, if just by making that statement, money saved up can mean a couple different things. That can mean by the end of the year, technically, if I've saved up $5, I got some money saved up. I did hit my goal. But is that what I really meant on the inside? And so making sure that you're getting really granular and specific in everything, because that's also going to allow you to have a clear path and direction to focus on. And so some things that you may find your SMART goal, and when you're making a goal and making it smart, may sound a little bit like this. By the end of the year, by December 1st, I want to make sure that I have at least 2,000 in my emergency savings. And I also want to set aside $600 for the holidays, because I'm tired of being a last minute shopper and feeling like I'm scrambling in order to get Christmas gifts for everyone. That could be a SMART goal. Another SMART goal is, I know I want to buy a new car next year. I don't want to finance the whole thing. So I'm thinking by February of next year, I want to have saved up at least around like 4,000 to put down for a down payment. That is also a SMART goal. Another SMART goal could also be, I know we're talking about buying a house next year, and I know I need to probably have some money for a down payment. And so I'm thinking, if we want to buy a house around June, just so I feel comfortable around March of next year, I would feel comfortable with 8,000 saved up for that down payment. And so getting a little specific, giving it that time expectation, also giving it also that time frame, and being specific as you can. And your SMART goals, and when you're making your financial goals, they can be short term and they can be long term. When we say short term, that's anything usually within the next 6 to 12 months, and long terms are anything from a year from now, also all the way, think of 10 years to as well. And so as we're going through and creating your short-term and long-term financial goals, it's important that you have both, right? We all have short-term goals, we all have long-term goals, but each of them should be specific. And so making sure that you have your goals. I know you may have it in your head, but actually take time, write it down, whether it's writing it on paper or if you have a spreadsheet or you're an online person, but go through it. And if it's not already made to be a SMART goal, take time to do that. And so now I want to shift gears and go a little bit as far as into the basics of banking and talk a little bit as far as the financial system itself, even as we're going to talk through the actual checking accounts, FDIC, and so much more. And then we'll talk a little bit more through that too as well. And again, if you have questions, please put it in the chat. And so I first want to talk about a checking account. And so I like to start here because a checking account is really one of the most essential and powerful budgeting tools that is out there for people. And I don't think sometimes people realize how much it is helpful from a budgeting perspective. A checking account is going to allow you to have that access to, if you need a debit card, if you're needing to write someone a check, you're going to have proof that you paid somebody, but also it's giving you more convenience. Also for me, it's safer than using cash. I don't know about you all, but if you've ever lost some money, that is a horrible feeling. And so nobody likes that. And so by having that checking account, there is that safety there, that protection there. If you have $20 in cash and you lose that $20, you're just out of it. Somebody stole $20 off of you, you're just out of that $20. Now, if a fraudster got $20 out of your checking account, there's a dispute process to get your money back. Also, you can deposit and cash checks for free. And so think about this too as well. um, not using check cashing places. If someone gives you a check, being able to negotiate things as things come up. I know I had someone recently say, people don't do checks anymore. What I will tell you is people don't do checks probably as much as they did, a few decades ago, but checks are still in circulation. And there's going to come a time where you're going to get a check, whether it's a rebate for something, whether it's you got a little extra money because of some insurance, or something's going to happen where you have a check. And so what do you do in those moments? So having that checking account so you can take care and manage your finances in those cases. But also from a budgeting perspective, the checking account is going to allow you access to have online banking. So it's giving you that digital record so you can track your income, you can track your spending, you can have all of that access right there. So instead of you trying to do all of that in your head and figure it all out, it's literally right there online. One of the things that I personally love at Truist, we just actually released it, I would say about 2 months ago. And I am using it for myself, and it has been a godsend, is we now have, it's an automatic system, a budgeting tool included into our online banking. I don't have to plug anything in. It will literally take from my transactions and separate everything and create my budget for me. That has been the best thing ever because it's literally made that process so much more streamlined, easier, save me time, but I literally now have an accurate reflection of what I'm spending. A couple things I want to talk to you all about in terms of a checking account. And that is things to look for when you're opening a checking account, when you're at your bank, right? And so I tell people this. Every bank, no matter if you are at Truist, I don't care if you're at Wells Fargo, I don't care if you're at Bank of America, you could be at a credit union, right? Everybody has a checking account. Everybody has a checking account. That's just the reality of it. However, the difference is no checking account is made the same. And what I mean by that is a Bank of America checking account may have a $20 maintenance fee and a certain this amount balance requirement. Truist checking account may have no maintenance fee and no balance requirement. A Wells Fargo, they're all different. Some give you perks, some don't. Some earn interest, some don't. There's many things to ask when you're opening a checking account. Just because it's a checking account, don't assume they are the same. And so things that you want to ask and check into to make sure that you're getting the right checking account for you. And even if you're at your current institution and you've been there for a while, do some research, right? There's nothing wrong with checking out to make sure it's the right thing for you and your finances. So the first thing you want to know is, does it earn interest on the balances that you have? And so you may say, well, it's a checking account. Checking accounts don't earn interest. That's not true. Some checking accounts will earn you interest. Now, it may not be a ton of interest, but you might still be able to get 0.01%. So knowing that, understanding that. Also, is there a monthly service fee, a monthly maintenance fee? That's important to know. So are you going to charge me just to have a checking account every single month? Are you going to charge me $10? Are you going to charge me $12? Are you not going to charge me? And then in addition to that, if there is a monthly service fee or maintenance fee, you also want to ask, do y'all have ways to avoid it? And so typically there are ways where they may say, okay, there is a $12 monthly maintenance fee, but if you get $500 worth of direct deposit a month, you don't get charged it. Or if you do 10 transactions a month, you don't get charged it. And so, but asking that question, don't just assume. And so I've had people sometimes say, well, my bank account, it doesn't charge me a monthly maintenance fee. What I will tell you is, don't just assume it doesn't have a monthly maintenance fee. You want to ask that question. It may just be that you're meeting the requirements to not get charged. And so you want to understand that. And so if any life situation changes, you're fully aware. Also, things to ask, do they have branch locations? What are their branch locations look like? So if anything happens, you need to go to a branch. Is it easily accessible to you? We'll want to also ask about overdraft. And so we'll talk about that here in a few more slides to go more in depth there too as well. But that's also a very, very important question. You'll also want to ask too, do they even have online banking? Is their online banking free? Do they have things such as mobile alerts? So will they let you know if your balance gets too low? Do they have things such as online bill pay? Do they have mobile deposit? All these things are convenience features that can make your life a lot easier and help protect you. Will they charge you to use ATMs? Do they offer debit cards? Do they have any reward programs with their debit cards? And so asking these questions, again, every bank, every credit union does checking accounts, but they are not all made equal. And so want to spend some time also talking about overdraft protection, overdraft coverage, because I mentioned that before. And so I like to just explain this in a couple different ways. Overdraft protection. Overdraft protection is literally a service where the bank is going to say, okay, something came through your account, you didn't have enough money for it. So say you had $10 in your account, but there was a charge coming through for $30, but you have a savings account. Do you want to link that savings account to your checking account for overdraft protection? Meaning, some charges coming through, we will transfer the money over from your savings to that checking account, so you do not get charged, so you do not get an overdraft fee. Now, what you also want to ask about overdraft protection, a couple things. One, overdraft protection, you typically have to have something in place for overdraft protection. So meaning you're either going to have a savings account, and with a savings account, you mean you got to have money in the savings in order for it to work. Or they may allow you to use like a credit card, or they may have an overdraft line of credit. Also, is there a fee for overdraft protection? So some banks charge a fee for overdraft protection to take place. Now it's going to be typically like $12, which is cheaper than that $36 overdraft fee per item, but you still want to know if there's a fee associated with it. Now, we'll also talk about overdraft coverage because that is different than overdraft protection. Overdraft coverage is more so pertaining to your debit card in real time, meaning they're going to ask you when you open your account, do you want to accept or decline overdraft coverage? And if you accept, that means say you're at the grocery store, you're trying to buy $50 worth of groceries, you only got $25 in your account. Do you want them to allow that transaction to go through, but you're going to get charged that overdraft fee? Or do you want them to decline that transaction because you don't have enough money in there? That is essentially overdraft coverage. Now, the overdraft coverage deals with a certain regulation, so they're going to ask you that regardless. But again, overdraft protection, you have to have something in place to protect that account. Anybody have any questions about overdraft coverage, overdraft protection? All right. I also just want to just touch on here too as well. You know, you're thinking about overdraft or overdraft. And so I would be remiss if I didn't touch on overdraft fees. Um, Overdraft fees will add up very quickly. And typically, an overdraft fee is going to be $36 per item that comes through your account while your account is overdrawn. So meaning, if you had 3 things come through your account, and all of those things came through and your account was net and it brought your account negative, they're going to charge you, and this is all on the same day, they're going to charge you three $36 overdraft fees. And if you had another charge the next day and it still went through and got paid, that's an additional overdraft fees. And so overdraft fees can add up very, very quickly. When you're thinking about your budget and when you're thinking about saving money, overdraft fees will eat it up quickly. And so be mindful of that. One of the things I'm happy about here at Truist is literally back in July, we got rid of all the different types of checking accounts we have. We only offer one now. It's called our Truist One Checking Account, and we no longer charge overdraft fees. To me, that was one of the most exciting things. I've been in the banking industry for over 11 years. It was exciting because I had never seen anything from any institution where they're no longer going to charge overdraft fees, because I firmly believe that is one of the literally overdraft fees. It sets people back, and it's so hard to recover from that. And so that is huge. That is a major thing too as well. And in addition to that, we're also going to start coming in November where we're offering people, as long as you're getting direct deposit, a $750 line of credit that's not even based on your credit score to kind of help cover things as they come through. Plus, we'll give you a $100 buffer if something needs to get paid and you don't have the money for it, it's still not charge you that overdraft fee. And so again, this is where I'll tell you, not everything is made the same. So do your research. The next thing I just want to touch on too as well is just FDIC. And so everyone's probably heard the term FDIC, but I just want to I like to briefly touch on this just to make sure that you're fully understanding, fully aware. And so FDIC stands for Federal Deposit Insurance Corporation. And essentially that's just going to insure your accounts at a bank up to $250,000 in case the bank fails. And so what that means, say you went to bed, and you woke up the next day in your bank and you turned on the news and you said your bank has gone under. FDIC is going to make sure that your money that you had in that bank account is still covered and you will still get your money. And so that is what's in place to protect you. I know sometimes I hear people say, I don't trust banks. What if they go under? What if the Great Depression? This is why the FDIC was created, to help protect in those certain situations. And FDIC is going to protect you anytime it's like a checking, savings, money market, CD, IRA, or anything of saving strategies. The first one is how do you control your spending? The next one is managing your debt. And then the last one is also saving for your future. And so when we talk about controlling your spending, there's a couple things you want to make sure that you're doing with this strategy. The first one is making sure, and I can't stress this enough, make sure your budget is real and reasonable. And the reason I say real and reasonable is because sometimes I have found that people over extend themselves or overexert themselves or make up unrealistic goals for themselves. It's okay if your budget and you're like it's tight and all I can do right here is this and all I can do right here, that is fine. Don't feel like you got to keep up with the Joneses. Don't feel like you got to do these things. Know your budget. That goes back to what we talked about earlier, understanding what you have, your income coming in, and then also your actual expenses that you're paying. One of the things you also want to do is look for ways that you could potentially cut some costs, right? When you're thinking about controlling your spending. And so I say this, and by cutting costs and looking at ways, that's going to allow for more disposable income. And we'll talk about things you can do with that. But things you can do to cut costs, right? So if you have, just an example, if you have 5 streaming services, so you have HBO Max, you have Netflix, you have Hulu, you have Amazon Prime, you have what's the other ones out there? Paramount Plus. You have all of those. The question is, do you need all of those? Right? You're paying these. Each of them may cost you $10 a month, $12 a month. You say, well, $10 a month ain't gonna hurt me. Well, 10 times 5 different streaming services, that's $50. Maybe you drop that down from 5 streaming services to maybe 3. I'm not saying get rid of all of them. Don't get me wrong. I enjoy Netflix just as much as the next person. It's one of my sanity expenses, but I don't need 5. So maybe I drop it down to 2 or 3. So what I will tell you is by doing that, that can essentially put back into your pocket. You went from paying $50 a month in streaming services to maybe $30 or $20. That's $30 or $20 that's going back to your disposable income. And you can look at either saving that $20, $30 or putting it down or putting a little extra towards some debt that you may have. Other things you want to look and consider too as well is ways you can make some additional money, right? So knowing skills that you're good at. And so if you know that you're good at babysitting, maybe you pick up and you do a little babysitting in the evenings if you have the time for it. If you know you're good at a trade or you have a side skill or things like that, don't be afraid to start that little side business that you've been thinking about. Think of ways you can create some extra income. Also, do periodic checkups of your budget. And the reason I say that is you want to put your budget in place. You want to put a plan in place. You have all these ideas such as how I'm going to, I made it real and reasonable. I cut these costs. I'm going to do extra, make this extra money, and it's going to work out great, right? But you want to check up on it maybe every 3 months or 6 months, especially as you're getting started to see, is this actually working? Don't wait and go a whole year and be like, wow, I achieved nothing. No, set periodic checkups for yourself to make sure you're actually getting to where you need to be. And then also periodic checkups to make sure you're getting the best deals, right? And so things change. I will tell you, that could be for insurance, cable, cell phone, internet. I'll share a personal story. I was with USAA for my personal auto insurance for 3 years. And I thought USAA was the best. Like in my mind, from what everybody told me, you couldn't beat USAA. Everybody wanted to be a USAA member, right? And so I was paying $250 a month for my personal auto insurance. And then after 3 years of paying $250 every single month, I was like, this is tiring. I'm over this. And so I looked around, and do you know I switched over to Progressive, and I went from paying $250 a month to $135 a month. 250 to 135. That's a big jump. That put over $100 a month back into my pocket to do extra stuff with. That's huge. I don't know about you all, but I like to have every dollar and penny that I can. And so that extra $100 that I got, I was able to put it somewhere else. I was able to put it a little extra principal towards some of the debt that I have. And so that kind of goes into the next strategy, which is managing your actual debt. And so when we're thinking about your budget, and one of the other strategy is to actually create within your budget a way to set aside funds to pay down your debt. And so during your expenses, when we were looking at that sheet earlier and you actually list out your expenses, there was a section around debt. And so think about actually putting some extra money towards that. A good rule of thumb is to use 10% of your monthly income to pay down debt. Now, here's the reality, right? That's a good rule of thumb. That's what they say. Is that going to work for everybody, especially if you're living paycheck to paycheck? It may not. Okay, that's the reality. But what I am going to tell you is make some sort of plan and strategy. If you're like, I'm living paycheck to paycheck, I can't do it. Okay, well, that's where we need to see maybe there are some ways we can cut some costs, or maybe I need to think of some ways I can get a little extra money so I can put at least something extra towards paying down these debts. Reducing your debt, that's a great way. It's going to increase your credit score, which is a huge important part of your financial life. And then also, if you can, pay more than the minimum to speed up progress on your debts. And the reason we say pay more than the minimum, when you're making your monthly payments every month, I just want to just make sure everybody is fully aware of this. When you're making your monthly payments, whether it's a credit card or whether it's your auto loan or your mortgage, that monthly payment every month does not go toward paying down that whole principal. So if you're paying for your, I'm going to give you an example, your auto loan is $300 and your actual loan amount is 20,000. That $300 you're making every month, not all of that is going to bring down your 20,000. Out of that 300, it's possible 200 of that is going just towards interest, and only 100 of that is going down towards bringing down that principal. And so the reason we say pay just a little extra each month to speed up that progress is because that's going to allow you to, one, get that debt off you quicker and sooner, and then two, as you're paying it down, if you pay it down sooner, that's less interest that you'll have to pay over the long run of period of time. And ultimately, in the grand scheme of things, that's going to save you money too as well. The other thing we want to talk about is just saving for your future. And so I know a lot of times people think, well, I don't have the money to save. I can't save. I got this, I got that. And what I will tell you is thinking about your future, saving for emergencies, that needs to be just as important. And the reason being is because emergencies happen. An emergency is not going to tell you, life ain't going to tell you, hey, in 3 weeks, I'm going to blow the tires out on your car. Just letting you know. It doesn't tell you that. The tires just blow, right? And now you need money. It doesn't tell you, hey, in 2 months, I just want to let you know the AC going to go out in your house and you're going to have to get a whole new AC unit. It doesn't tell you that. It just happens. And so making sure that you are saving for the future, saving for emergencies. Also thinking about retirement too as well. Saving for retirement. I tell people all the time, I love my job. I love what I do. I love having these conversations. I love bringing financial literacy out into the communities. However, I don't want to work forever. I want to retire. I want to be able to do what I want to do, vacation and travel and see the world. And so saving for my retirement, that's a real thing. And if you're the type of person that's like, I would love to retire one day, it can be a reality, but you have to make it a priority. And so thinking about saving for your future, they say also here, a good rule of thumb, 10% of your paycheck into an emergency savings fund. Here's what I'm going to tell you. Again, if you're starting, you're like, I don't even have, 10%, you want me to put $200 a month into my emergency savings fund. Where I'm going to get this extra 200? I use everything. Let me start you small. Start small. Start somewhere. So as you're going through and maybe you're figuring out that disposable income, you reworked and you found some ways to cut some costs, and now you come up and you're like, all right, I got it. I reworked some stuff, but I now have just an extra $30 a month. That's a great start. Take that extra $30 and put it into an emergency savings fund, because part of that is also creating some discipline for yourself too as well. And also think about contributing to a retirement fund. Okay. So if you're employed, you have a job, look into it. If you're not contributing and they offer a 401k, questions you want to ask. Do y'all match it up to a certain percentage? If your job is matching, you want it to, that's free money. Take advantage of it. And then also thinking about your kids. If they're going to school, they want to go to college, if you want to set up a college fund for them, if that's possible. But don't, again, I can't stress this enough, don't not take advantage and think about yourself. Saving for your future, saving for emergencies is equally just as important and a huge part of your budget. You should actually be including that in there as well. And so want to just show this. I think this is a great little chart. You may be like, well, how can, $20, $10 ain't gonna do much. And so I think this is a good chart just to kind of show what is possible every single month. And so this just gives an example. So say you were to save, I'll start on the lower end. Say you save $10 every single month. Well, in 1 year, you've did a yearly savings of $120. And then in a total of 5 years, you did 600. But I will tell you, some of us like, well, that's not a lot of money. Well, what I will tell you is that's more saved than what you had if you did zero. I always tell them, anything is better than zero. And then think about this. If you're able to do $50 a month into your savings, your yearly savings be 600, and then in 5 years, 3,000. And so just think about if you can do more, but find what you can do. Look in your budget, maybe tweak some things and work on what you can and find what you can do, but making sure that you save is an important priority. Some strategies I just want you to remember in order to be a successful saver. Make sure you pay yourself first. It's just as important as your rent or your electricity bill. And then also set up an automatic deposit into your savings account. And so a lot of times you can do just set up an auto transfer. So when you get paid, it'll automatically transfer over. If that's that $20 or $30, you can set that up because again, out of sight, out of mind, what you don't see, you won't spend. And then start as early as you can. So take time, figure it out now. And especially if you have that long-term goal, don't wait, but start now. And so just thinking about your savings goals and your planning, ask yourself just a couple questions. What do you want to achieve? What are your financial goals? And how much will you actually need for your goals? Few things I just want to also talk about is just some different savings options that you would see at most banks and financial institutions. So if you were to go into the bank and they were to talk to you and you say, I want to set up a savings, just want to make sure everybody is just kind of have a general idea of what these savings options are, okay? And so the first one would be a savings account. A savings account that's going to be liquid, so meaning that you're not tying your money up for a long period of time. You're going to put your money in the savings account. And they're going to give you interest on it. Now, what I will tell you with the savings account, it is meant for saving. So that means that there are only a certain amount of withdrawals you can do from that savings account per month before you actually get charged an excessive withdrawal fee. Typically, it is, depending on the bank and the institution, it's anywhere between 2 to 6 withdrawals per month before you get charged an excessive withdrawal fee. Now, here's what I tell you. You may be like, well, why are they going to charge me a fee? Well, the goal is to save. And so if your goal is to save and that's your savings account and you've already dipped into it 6 times in a month, are you really using that to save? So think about it that way, right? But that's what you would see. Now, the interest on a regular savings account is probably not going to be that high. You still might get you a 0.01%. Another option you may hear that goes along with the savings account is they may say a money market savings account. And that's typically if you have larger balances that you're saved up, you've got more than $1,000 or things like that. And that's usually a tiered interest rate. So the more you have in there, the more you'll actually earn in terms of interest. But with the money market savings still liquid, it's still going to give you that tiered interest rate too as well, but it still also has that excessive withdrawal fee if you go over more than those 6 withdrawals from it per month. Another thing that you would see as a savings option at a financial institution. We don't have it on here, but I want to make you aware because I'm sure you probably heard somebody talk about a CD or a certificate of deposit. And so a CD or certificate of deposit is essentially this. That is, you take into the bank, say you have $2,000 and you say, I got this $2,000 and the bank say, okay, great. And they'll say, well, if you leave this $2,000 with us for an X amount of time, and they'll give you, there's options. You can lock it up for 6 months on up to maybe 3-4 years. You do that, we're going to give you this rate. And typically, certificate of deposit CD rates are much higher than a savings account rate. The reason being is because the promise is you put this in here, you're going to leave it in here for this amount of time, you're not going to touch it. Even if you touch it once, there is a penalty. And I will tell you the penalty on the CD is much higher. Usually we'll lose all of the interest or a good chunk, right? And so be mindful of that. What I will tell you is before you think about a CD, make sure that you have enough money saved up regularly liquid, because again, you're locking that up for a period of time. And a CD is not an investment. So it's not investing, it's not going on the stock market. That's literally the reason the bank gives you that higher interest rate, is because it is just putting in there for that period of time, that term. You have your health savings account, which is literally a savings account that's meant just to be used for medical expenses. So putting money aside in there, typically you'll have that going on along. You can set up yourself, or maybe through your benefits of your job, but any medical expense. So if you have a doctor's office or anything like that, or doctor's appointment, or you need to buy your medicine, you can use your health savings account for that. You can't use that for anything else outside of medical expenses. And then you have your IRAs. IRAs, that stands for individual retirement account. And that is literally for you from thinking about planning for retirement. So this is different from your 401k. Your 401k is going to be through your job, but your IRA is something you would set up yourself. You can go to the bank, say, I want to set up an IRA, start, putting money aside. There's two different types of IRAs. We have a Roth IRA and a traditional IRA. Now, here's the difference between it. A Roth IRA, you paid the taxes on the money you put in there up front. So that means when it's time when you're actually retiring and drawing from it, you don't pay taxes on that. A traditional IRA, the money you put in there is tax deferred, meaning you put the money in there and you don't pay any taxes on that money until you actually retire and draw that money later on down the road. Some reasons a lot of people do traditional IRAs as well is because that can help them at tax time get a higher refund. But talk to your tax advisor about that too as well. They'll let you know if you need to go or put some money in an IRA so you can get into a lower tax bracket. But again, just wanted to go over the different types of savings options that you'll see at most financial institutions. Now, what I will tell you is these are savings from at the bank level. Now, there are also investments. When we're talking about investments, you are going to have to actually speak to a licensed investments person. And the reason being is because investments deal with they're not FDIC insured. Everything we talked about here is FDIC insured. Investments are not FDIC insured. And so you got to understand the risks that go into it, what protections are there. And so you want to ask a lot of questions. Is it tied to the market, and things of that nature. But there are many different types of investments, but understand that at that point, you're going from non-FDIC insured products and solutions. So you want to make sure that, one, ask questions even about the person that you're talking with, who would be the one investing the money for you. How long have you been in business? How long have you been doing this? What's your client base like? Do your research. And that way you feel a little bit comfortable about the advice that you're getting, the institution that's handling the investments for you, and everything of that nature too as well. And so I want to just share some additional resources that we have out here that I think will be a great benefit and help. This is our money and mindset page. And so a couple things I would share. You can get to this page either by scanning the QR code that's up here on the screen, or you can go to truist.com and get to money and mindset that way. You don't have to be a Truist client to use our money and mindset information, but things out there. If you're like, I need to get a budget, we have articles, calculators, and tools. So there is a budget spreadsheet out there you can use. We have calculators. So if you want to say, if I pay this down, or if you're trying to do math, or you're one of those people and trying to figure out how much do I need to save to do this? What would it cost me to do this? We have all of those articles, calculators, tools, so much stuff you can read up and learn about too as well. If you're trying to learn about how to be better at savings and budgeting and everything, there are resources out here. There's a fun little financial personality quiz. So find out about yourself and how you view money and how you spend. And if you're a podcast person, we have a money and mindset podcast with some great helpful information and tips out there too as well. What I also will tell you again, this is just, a starting point. This is some basic information. This is just to kind of give you some high level stuff. But again, everybody's personal finances and situation are different. And so what I will tell you is take this information. The hard part comes next. Actually do something with it. And so if you don't have anyone that you work with at a bank, if you haven't gone into the bank in a while, go in. You can stop at any Truist branch or wherever you're banking at, but have that conversation. If your bankers or wherever you're banking at and they're not having that conversation with you and they're not acting like they don't want to help you achieve your financial goals, reevaluate that, because literally that's our job. We're here to serve you in the banking industry, to make sure we're helping you get to where you need to be, and then also bringing you the resources and the tips to help you get there too as well. And so if there were any questions, I will stop sharing my screen. I didn't know if there was any questions, or I could turn it back over to you all.